What is going on YouTube? I'm Mike with Penner Investments, and today I'm going to discuss trading the SPY in the wheel strategy. Be sure to hit the like button, share this video so that others may learn, and subscribe to my channel so you do not miss out on future content. Alright, let's jump in. I know I keep sounding like a broken record on the wheel strategy, but this really is my biggest moneymaker. I'm starting to include the SPY into trading the wheel strategy as the QQQ is very successful. The SPY is an ETF just like the QQQ, except for the SPY tracks the S&P 500. So this is 500 companies in this one fund, and it's very diversified, which makes it a little safer than trading single stocks. Again, I always like to wait till there's a 2% pullback, or close as possible to the 2% pullback if we're in a bull market, where you're not getting too many of the 2% opportunities to enter a trade. But either way, I started out by entering cash secured puts. Let's take a look at the SPY options chain. I would not enter this trade today as the market is currently up. Premiums are a little better on the put side if you wait for that down day, especially once we start seeing 2% or better, or at least close to the 2%. If I'm having lots of extra cash or just wanting to be aggressive on this put for the higher premiums, I like to target the 40% delta. This would put me at a strike price of $410 with a $688 premium per contract, and I always like to do a few contracts on these trades. If I wanted to be a little less aggressive and more conservative, I would target the 35% delta, putting me at the $407 strike price, but still a very nice premium of just over $590 per contract. This would give the SPY close to 1.5% pullback before putting this trade in the money. And then don't forget I took in a $590 credit that also reduces my cost basis another 1.4%, giving me pretty close to a 3% pullback before I'd be in the red on this trade. Keep in mind, in the wheel strategy, getting assigned is not a bad thing, even though it's nice to sit back and collect that premium each 30 days on the puts. That easy money is pretty nice. But remember, once I get assigned the puts, we're going to flip it around and start doing calls, do covered calls, because that's the whole wheel strategy. Selling puts into assigned and then covered calls once we're assigned, and continue selling covered calls until we're exercised. On the call side, I like to move out 45 days on the expiration date on the covered calls. Then I'd look for around a 25% delta, which would give me a little bit of room for appreciation on the trade while still giving me a decent premium. On stocks that have a little bit more movement, on some of the tech stocks, I like to go a little further away from the money. Or if you're in a stock or ETF and you do want it to get called away to free up the money, then you can always move your strike price a little bit closer if you want it to get called away. For the SPY, I like the 25% delta here, setting the call strike price at $433 for a credit of $318 per contract. You can see here with the SPY, similar to the QQQ, you have a little less volatile trade, but you have to pay a small price for having a less volatile stock by not getting quite as juicy premiums as you would if you were selling it on a NVIDIA or Snowflake or AMD or whatnot, but you do get a little added safety. Again, once assigned, I just keep selling covered calls until they are exercised, and from there it's just rinse and repeat, and then I go back to selling cash secured puts. As always, if there's ever anything you would like me to discuss further, drop a comment in the box below. Thanks for watching and good luck trading.